Did you know a single number, often unseen and unspoken, set by a handful of people in closed-door meetings and complex economic forecasts, can decide if you get your dream home, if that white picket fence becomes a reality, or if your morning coffee costs more, making that daily ritual a little more expensive? That's the power of interest rates, a force that shapes our financial landscape. This 1 percentage point, seemingly insignificant, quietly dictates the cost of everything, influencing prices across the board, from cars, the vehicles we rely on, to groceries, the essentials that fill our tables. It's the invisible hand, a subtle yet powerful mechanism, squeezing or freeing your budget, impacting how much you can save or spend, impacting your money right now, shaping your daily financial decisions. Most people ignore it, unaware of its pervasive influence, but interest rates run the show, orchestrating the financial symphony around us, behind your financial life, pulling the strings in ways you might not realize. So, let's pull back the curtain and reveal the inner workings of this financial force. What are interest rates, in their simplest form? How are they set and who decides their fate? And why does a tiny change, a seemingly insignificant adjustment, ripple through your wallet, creating waves of financial consequences? By the end, you'll see, with newfound clarity, why paying attention to interest rates and understanding their impact is one of the smartest moves for your financial future, empowering you to make informed decisions and secure a brighter tomorrow. So, what exactly is an interest rate? It's a term we hear all the time in the news and in our daily lives, but understanding what it truly represents is key to making informed financial decisions. At its core, it's the cost of using someone else's money. Think of it as a rental fee for borrowing funds. This cost is usually shown as a percentage of the principal amount. This percentage determines how much extra you'll pay on top of the original sum. For example, imagine you borrow $100 at a 5% annual interest rate for a year. At the end of that year, you'll pay back $105. That extra $5 is the interest, the price you pay for the convenience of using the lender's money. It's also the lender's reward for taking on the risk that you might not pay them back. They need to be compensated for that possibility. But remember, the tables turn when you save, then you're the lender. Banks use your deposited money to fund loans to other customers and businesses. And in return for letting them use your money, they pay you interest. Now, among all the different interest rates out there, the most important rate to watch is the one set by the central bank, like the Federal Reserve in the United States. This rate essentially becomes the wholesale price of money when banks lend to each other. When the Fed decides to raise or lower rates, it has a ripple effect that impacts your credit cards, car loans, mortgages, and even the interest you earn on your savings accounts. Generally, high rates tend to slow down spending and help to cool down inflation, as borrowing becomes more expensive. Conversely, low rates encourage borrowing, which can stimulate economic growth and business expansion. It's a delicate balancing act to keep the economy running smoothly and avoid extreme booms or busts. That's why every rate change, even seemingly small ones, matters to you and your financial well-being. Have you ever stopped to consider how interest rates, often discussed in hushed tones in financial circles, actually impact the rhythm of your daily life? It's more pervasive than you might think. Let's start with your job, the cornerstone of your financial well-being. Low interest rates make it cheaper for businesses to borrow capital, fueling expansion plans, and creating opportunities to hire more staff. This translates to more jobs being created and the potential for better pay as companies compete for talent. But what about high rates? Borrowing gets significantly more expensive, causing projects to stall due to increased costs and tighter budgets. Unfortunately, layoffs can often follow as companies struggle to maintain profitability. Rent prices tend to increase when interest rates rise, primarily because landlords are faced with higher mortgage payments on their properties. To offset these increased costs, landlords often pass those expenses directly to their tenants in the form of higher rent. Elevated interest rates also discourage renters from taking the plunge and buying homes, which further intensifies demand for rental properties, pushing rent prices even higher in a competitive market. Now, let's consider your savings. Generally, rising interest rates mean your money has the potential to grow at a faster pace when it's sitting in a bank account or other interest-bearing investment. Conversely, when rates drop, your savings accounts and similar investments typically earn less interest. This can lead to your savings losing ground when compared to the rising cost of goods and services due to inflation. That's precisely why keeping a close eye on interest rate trends is crucial. It directly impacts your paycheck, your rent expenses, and the growth of your savings. Interest rates fundamentally shape your financial reality and influence your day-to-day financial decisions more than you might realize. Interest rates don't just affect you, they shape the whole economy. Low rates boost company profits and stock prices, as investors chase higher returns in the market. When rates rise, safe savings accounts become more attractive, and money leaves stocks, often triggering a downturn. Rates also impact global trade and currency values. Higher US rates attract foreign investors, strengthening the dollar. A strong dollar makes imports cheaper, but hurts American exports and jobs. If you travel abroad, a strong dollar is great. But if you work in exports, it can mean fewer sales and job cuts. All this from a single rate change, proving how interconnected the world's finances really are. Interest rates are the economy's steering wheel. Why track interest rates? Because knowledge is power. If rates are rising, you might lock in a mortgage or pay off variable debt before it gets pricier. If rates fall, you could refinance or seek better investments as savings returns drop. Understanding rates lets you plan, not just react, saving you thousands over time. Interest rates are the economy's heartbeat, signaling when to act and when to wait. Ignore them, and you're sailing blind. Pay attention, and you're in control. Master this one lever and you're ready to make smart moves, no matter which way the economic winds blow.